In this video, you will learn classic chart patterns and formations. When suitably identified, it frequently leads to an explosive breakout, so watch out. Remember, our aim is to spot big movements before they happen so that we rake in the cash. Think of chart patterns as a landmine detector, because once you finish watching this video, you will be able to spot explosions on the charts before they even happen, potentially making you a lot of money in the process.
Subscribe to this channel for more videos so that you don't miss any update. And don't fail to hit the like and share buttons so that your friends can see it.
Chart formations will significantly aid us spot settings where the price is ready to break out in a certain direction. There are three main groups of chart patterns. Number 1. Reversal chart patterns. Reversal patterns are those chart formations that signal that the current trend is about to change direction. Rising wedge chart pattern is a reversal chart pattern. Number 2. Continuation chart patterns. Continuation chart patterns are those chart formations that signal that the current trend will resume after consolidation. Bullish rectangle is a chart pattern that indicates continuation of a trend. Number 3. Bilateral chart patterns. Bilateral chart patterns are a little more complex, because these signal that the price can move either way, up or down. Symmetrical triangle is a chart pattern that can be a continuation of a trend or reversal. Chart patterns can also point out whether the price will continue in its current direction or reverse, so we'll also be planning some smart trade strategies for these chart patterns. In a nutshell, chart patterns help you solve three problems. Number 1. How do I find possible entry points in a rising or falling trend? Number 2. How can chart patterns offer likely entry signals? Number 3. How do I know when to get out, either to take profit if the chart pattern worked, or cut my losses if the chart pattern failed? We are going to solve these three problems with demonstrations and explanations, so keep watching. We are going to explain in details and demonstrate all the chart patterns and strategies on how to trade with them. Let us start with reversal chart patterns. We are going to cover 6 chart patterns that give reversal signals, namely double top, double bottom, head and shoulders, inverse head and shoulders, rising wedge, falling wedge. If a reversal chart pattern forms during an uptrend, it hints that the trend will reverse and that the price will drop down soon. Conversely, if a reversal chart pattern is seen during a downtrend, it suggests that the price will push up later. How to trade double tops and double bottoms. A double top is a reversal pattern that is formed after there is an stretched move up. The tops are peaks that are formed when the price hits a certain level that can't be broken. After hitting this level, the price will bounce off it a little, but then return back to test the level again. If the price bounces off of that level again, then you have a double top. In the chart you can see that 2 tops were formed after a strong move up. Notice how the second top was not able to break the high of the first top. This is a strong sign that a reversal is going to happen, since it is telling us that the buying force is just about ended. With the double top, we would place our entry order below the neckline because we are expecting a reversal of the uptrend. Looking at the chart, you can see that the price breaks the neckline and makes a fine move down. Do not forget that double tops are a trend reversal formation, so you'll want to look for these after there is a strong uptrend. You'll also notice that the drop is approximately the same height as the double top formation. Keep that in mind because that'll be useful in setting profit targets. Alternatively and aggressively, one can enter a trade here, below the pin bar, which is a reversal candle pattern. Put a stop loss here and take profit here. If the take profit is achieved, wait for a break of the neckline. If the neck is broken, then enter another trade after the close of the breaking candle. Put the stop loss here and take profit here. The double bottom is also a trend reversal formation, but this time we are looking to buy instead of sell. These formations occur after long drawn-out downtrends, when two bottoms have been formed. You can see from the chart that after the previous downtrend, the price formed two valleys because it wasn't able to go beneath a certain level. Notice how the second bottom wasn't able to significantly break down the first bottom. This is a signal that the selling pressure is about finished, and that a reversal is about to take place. The price broke the neckline and made a good move up. See how the price jumped by almost the same height as that of the double bottom formation. Remember, just like double tops, double bottoms are also trend reversal formations. You'll want to look for these after a strong downtrend. Double bottom has the same trading strategy, just as the double top, but in opposite direction. We are going to demonstrate how to trade wedge chart patterns. A wedge is a chart pattern marked by joining trend lines on a price chart. The pattern involves two trend lines that move in the same direction, as the channel gets tighter, until one of the trend lines gets broken. The resultant shape forms a gradually contracting wedge. The upper trend line acts as resistance, while the lower trend line acts as support. There are two types of wedge chart patterns. 1. Rising wedge, which signals a bearish reversal. 2. Falling wedge, which signals a bullish reversal. If the rising wedge forms after an uptrend, it's usually a bearish reversal pattern. On the other hand, if it forms during a downtrend, it could signal a continuation of the down move. Either way, the important thing is that, when you spot this Forex trading chart pattern, you're ready with your entry orders. See how price broke down to the downside? That means there are more Forex traders desperate to be short than be long. They pushed the price down to break the trend line, indicating that a downtrend may be in the cards. Just like in the other Forex trading chart patterns we discussed earlier, the price movement after the breakout is approximately the same magnitude as the height of the formation. Each time you see rising wedge, in any time frame, whether in an uptrend or in a downtrend, get ready to sell. You are to put a sell stop order here, and have your stop loss here, then your take profit should be here, based on the height of the formation. How to trade the falling wedge. Just like the rising wedge, the falling wedge can either be a reversal or continuation signal. As a reversal signal, it is formed at a bottom of a downtrend, indicating that an uptrend would come next. As a continuation signal, it is formed during an uptrend, implying that the upward price action would resume. Unlike the rising wedge, the falling wedge is a bullish chart pattern. In this chart, the falling wedge serves as a reversal signal. After a downtrend, the price made lower highs and lower lows. After breaking above the top of the wedge, the price made a nice move upwards, that is almost to the height of the formation. In this case, the price rally went a few more pips beyond that target. As we mentioned earlier, when the falling wedge forms during an uptrend, it usually signals that the trend will resume later on. In this case, the price consolidated for a bit, after a strong rally. This could mean that buyers simply paused to catch their breath, and probably recruited more people to join the bull camp. The head and shoulders chart pattern is a reversal pattern, and most often seen in uptrends. We are going to demonstrate how to trade the pattern. Keep watching. A head and shoulders pattern is also a trend reversal formation. It is formed by a peak, being the first shoulder, followed by a higher peak, known as the head, and then another lower peak, being the second shoulder. A neckline is drawn by connecting the lowest points of the two troughs. The head is the second peak, and is the highest point in the pattern. The two shoulders also form peaks, but do not exceed the height of the head. With this formation, we put an entry order below the neckline. We can also calculate a target by measuring the high point of the head to the neckline. This distance is approximately how far the price will move after it breaks the neckline. You can see that once the price goes below the neckline, it makes a move that is at least the size of the distance between the head and the neckline. Inverse head and shoulders. The name speaks for itself. It is basically a head and shoulders formation, except this time it's upside down. A valley is formed, shoulder, followed by an even lower valley, head, and then another higher valley, shoulder. These formations occur after extended downward movements. Here you can see that this is just like a head and shoulders pattern, but it's flipped upside down. With this formation, we would place a long entry order above the neckline. Our target is calculated just like the head and shoulders pattern. Measure the distance between the head and the neckline, and that is approximately the distance that the price will move after it breaks the neckline. You can see that the price moved up nicely after it broke the neckline.
Part 2 of chart patterns will be released soon, so subscribe in order to watch it when it will be released. It is going to be our next video.
Subscribe to this channel for more videos so that you don't miss any update. And don't fail to hit the like and share buttons so that your friends can see it.
Please drop your comment below.
Thanks for watching.